So happy to be here. I'm from Curve. I work for Curve currently as a BD. That's my role. But I have a history in blockchain, and since more than a decade, I was playing around all the protocols that have been showing up on Ethereum mainnet. And since 2 years, I'm doing BD for Curve. I have a technical background too, and I did think a lot about money, and I talk about moneyness here too. So yeah, so that's about me. So now I'm a DeFi, I have a DeFi brain basically, I would say, basically. So I don't know how well you know Curve. This is like the overview. I will shortly speak about Curve, then the history of yield in crypto, and then how stablecoins are different from cash. What's the quality of a stablecoin, because underlying of every yield-bearing token is like a stablecoin. Then we go in a short example. Then I talk about the different nature of yield in stablecoin and also what's missing in this space currently. And then I will have an outlook. So, yeah. So first question, who did ever like farming for rewards or tokens here? Who's using like on-chain capital and getting some yield? Okay, a few. And you still do it? You still do it actively? Okay. Okay, so you don't, yeah, that's good, only a few, so you don't know the world very well, so yeah, I have a lot to tell. So Curve basically is one of it's shortly after the first iteration of Uniswap. Curve, our founder, he invented like the StableSwap, and StableSwap is just still the leading AMM for correlated assets basically, and it doesn't have any position like Uniswap v3, it just has one LP token, and we're still like improving this one. It also has a CryptoSwap, which is like for non-correlated assets. And then 2 years ago, we made a collateral depth position stablecoin called Curve USD. So we have our own stablecoin. And we also have a saving version of this stablecoin called Serving Curve USD. We also have a lending market. So basically, it's a whole suite, a DeFi suite we have for Curve. So, but this talk is about yield. So, yeah, this is like the sentence from the past. If you don't know the source of yield, you are the yield, basically. Because if you go historically back, as the DeFi summer happening, people have been forced farming these times. You use basically a token of a project, and you paired it to ETH or to a USD stablecoin, you put it in the liquidity pool, because the goal of this project was having trading liquidity. So basically, you bought the token, or you got the token as airdrop, you put it in the pool, and then you got crazy API, and the API has been paid in this project's token. And of course, this is a project, I don't name it, but you see the price of the token is constantly going down, so most of the time, yeah, you lost money, or only short time you could make a lot of money. You have to sell constantly, but like hourly you have to withdraw and sell. But normally the price was dropping constantly, and at the end the token is just going to close to zero. So this was like, yeah, everyone played these games, but at the end was like, okay, well, I'm losing money. So somehow then it was like the next step was, okay, yield being stablecoins. So if you can make farm revenues with the stablecoin, then you don't have the issue that basically your pool is getting less and less worth. So most of the team started, then a lot of stablecoins have been popping out. So project made especially stablecoins, which you could farm. They also had like a token, and this is a stablecoin token. It's a token from a stablecoin project, who is dead now, basically. And then everyone was like cheering, yes, yield being stablecoin, it's cool. So basically, you can have a stablecoin who then pays you interest rate, and then you don't lose the value in the inflation, because you get at least some kind of payment back. So you get yield on your stablecoin to offset the inflation. The issue with this is, so you have to pay taxes on the income. So it's a hedge, but otherwise, you at the same time, if you do your taxes, you have to pay some income tax on this one. So somehow it was a solution, it worked, and it's still like a dominant way to farm, basically. People want to have stablecoins to farm, because then you don't lose the token value is not constantly going down, it's stable. And if you are doing it well, then you shift your position from one farm to another one. So this leads me to talking about moneyness of stablecoins. And the issue is, it's not an issue, but if you look into stablecoins, stablecoins are not cash. Some people think it's cash because you can directly send it to someone. It's a replacement of cash on chain, that's true. But it's much more, because there's like a special stablecoins have a property which normal fiat or cash doesn't have. So if you look like in moneyness, it's like every money should be, stable money should be unit of account, so you calculate in this. Then it's a medium of exchange, you can buy things with it. It's a store of value, you can basically store value over time. And the new thing is with stablecoins, they are also a means of speculation. So stablecoins have another properties, they just are a mean of speculation. And if you think about many of these stablecoins who popping up and they're there for a moment and then they disappear, and the reason why it's so short-lived is because people just hold them as a means of speculation, not as medium of account and not of a store of value. It's just like, you hold it short time, you milk the project and then you move on. So also, this is a side note, on Curve we did think, as we has like Curve USD, we did think a lot about moneyness, how can you make Curve USD create a demand? And it's already a unit of account because it's dollar-based. It's a medium of exchange. And the good position about Curve, because we are an exchange, an on-chain exchange, we can basically work in the property of the medium of exchange. Because as the more pools we create with Curve USD, the more it gets used as a medium of exchange. So basically, you can hold Curve USD short time and then trade for another token, and it's quite okay. But the store of value part, and you see in different stablecoins, the store of value part is very hard to reach, because store of value basically it's only reachable with trust. So at the point people are trusting your coin that it doesn't like go down the next days or fail, then people over some time they're not going back to another stablecoin who is more dominant. But you also see the most dominant stablecoins, the reason why they're so dominant is basically because they are like a store of value, in the sense people really use it to just have cash basically on chain. And the means of speculation is not like, in a way you can say, we also have like a S-die curve, we have a saving curve USD, and there you see, this is kind where we play the means of speculation part in this. And the thing is, I will explain this later. So if you go in the mean of speculation, if you remember the first project token was constantly going down, this is the stablecoin who is like, this is stablecoin which it produced. And it's highly volatile. Even this, the most deviation it has was like 30%. So it was heavily, at some point it had some upacks. Yeah, maybe that's fine as a whole, the downpacks are much worse. But it should not downpack basically, uppack, it should be stable. And this is over a year. And then if you compare this to Curve USD, it looks like very unstable because of the scale. So I did put it to scale, and if you overlap the two graphs and put it to scale, then you see Curve USD is very stable if you compare it to the other one. And it even got much more stable right now. So it's very good. And the reason why I'm showing this, if you farm a token and you want to produce a yield of the token, the peg of the token basically is the highest signal of the quality of the token. So if a stablecoin can hold the peg very close, you can assume the quality is good. And this is like very simple to find out. You just look at the stablecoin and you see what's going on. This is the reason why, the quality basically is the peg. And this is, everyone tries to have a very close peg, and if you are able to achieve this, then you see the quality. So if you look at different stablecoins and you want to judge them by the quality, even also if you farm, you see a little bit of the history, then you see what's the quality. And the reason why this is the case is because stablecoins, CDP stablecoins I'm mostly talking about, people and the way work, you have a collateral like ETH, so you take your ETH, you lend out the stablecoin, and then it's like a special lending protocol in a way. It's special in a way because you lend a stablecoin. In other lending protocols, you can have a collateral and you can lend other assets, but in a stablecoin protocol, basically you lend a stablecoin. And the thing is, every issue with the collateral you see in the quality of the stablecoin. So if a stablecoin uses collateral who has not a good quality, or it has issues, it's very volatile, or it fails, or it gets hacked, then you may see it in the pack, basically, because then you have a trust issue with the stablecoin. So stablecoin, basically, and I guess this is also true for treasury-backed stablecoins. The quality is always visible in the pack or long term. And we did see DPEGs of some have recovered, of course, like some of them recovered, but many of them go down and never recover, basically. So next, I'm going to go in an example, because I will see not everyone is like in this world, so I show you how you can basically, what's a real being stablecoin and how you can make reward out of this. And I'm using the S-Curve USD we have, and this is the token. The saving Curve USD is the Curve USD, who gives you a kickback of the income Curve generates. And it's real income. So now it's 7%. I did this like 2 days ago, it was like 4% basically. But now it's like 7%. And it's real yield in the sense, what we do is basically, if people mint Curve USD out of Ethereum, then you pay a rate for this. And we take part of the rate, so you pay interest rate, and we take part of the rate, and we forward it to the S-Curve USD holders. And what we do here is also like connected to the medium of speculation, because Curve USD is mostly used to go long. So this means people basically, they take the ETH, they lend Curve USD, and then they use the Curve USD to buy more ETH, basically. So they speculate on the price going up of their collateral or other like crypto tokens. And what we do here is basically we use the income from the most degenerate users. They take risk. We take the income and we forward it to the most conservative one, and then you can just basically hold the S-Curve USD, and then you get you get paid an interest rate for this. So we shift basically from the part we have income from the most risk-taking ones, we shift to the one who want to have it with way less risk and just a stable rate. So this is an example which currently this is the rate who is currently on. So this is how you basically can make reward of stablecoin, how you can farm stablecoin or generate some income. So you take S-Curve USD, you pay it with S dollar. S dollar is another collateral debt stablecoin. You put it into a stable pool on Curve, and for this you get different rewards. So first you get like the asset yield of the two tokens. So it's like this calculation, it's 6%. You get like the base yield of these two tokens who are in the pool, and you still own them, so you get rewards. Then you get on top, you get the trading fees. Trading fee is quite high here, so you take 6% over a year. It's not like this is a weekly rate, so it's like this adds up to 11%. And then on top you get the Curve reward, because Curve basically pays you for providing liquidity into this one. So you make like 16% here. Now it's even more because S-Curve USD jumped to 7%, so it's like almost 18 or 19% right now. So which kind of risk you're taking if you do this? So you have, of course, you have asset risk. Basically, you have the risk of S-Curve USD and you have the issue of S dollar. And if one of them fails, you are exposed to you both are exposed to them, because at this point the pool will get has issue, and the value of the pool will go down. Then you have the pool risk, so you assume Curve is safe, and Curve is very safe because it's very battle tested. So it's quite safe. So you have this kind of risk. Also, you have the risk of the Curve token risk in a sense, because part of your reward is basically in Curve, and Curve is a volatile asset. So you either can basically compound, and this means you have to redraw the curve and sell it every day, every week, or you basically can speculate that the price will go up of curve, it's not unlikely in this case, but in many other stablecoins we did see the price basically going constantly down. Stablecoin projects which had a token, so the price constantly down, so you have to compound because otherwise you will not have these rewards. And the thing is also, you also have like a risk who is like a timing risk, and this is more related to taxes because in a way you have to pay taxes on this. And there are stories of people who did heavily farm in DeFi summer and they made a lot of income. On the books they had a lot of income because the time you get the token, basically that's the taxable event in many countries. Then it's income, but they did hold the token. The whole token has been going constantly down, and so they have like a more tax debt than they have money on the other side. So, but that's not the case anymore. I just say, in a way, it changed. The industry changed a little bit in the sense that now, you can farm stablecoin, and then you have more like sustainable rewards who also in the future have the same value. So the question is first, do you need so if you don't know the source of yield, you are the yield. I'm not sure if this is completely true. It's much more that you need to understand the nature of your yield and the different nature of yield. One is real yield, is real revenue from a project, and the other one is speculative yield. And the real yield is more sustainable long term, and the speculative yield is more short term, basically. And if you look into real yield, there's like, of course, there's yield from US treasuries. There are token rounds where you get a kickback. So these are not like USD, or these are like treasury-backed stablecoins, like USDM was a project, but now it was like, it got acquired. But the way there was like, basically you send them fiat, they buy US Treasury for it as a backing of the stablecoin, and you get a part of the interest rate you get forwarded to the stablecoin. So basically you get the treasury yield on the stablecoin. Then there are like stablecoin yield who are like, they are more like a reward on a provided capital. Athena for me is like this category. It's like a stabilized capital. You give them capital, it shows up as a stablecoin, but at the end they use your capital as a for the protocol to work with, basically, and you get a reward for that. Then there's yield from predatory revenue. I just said S-curve USD, S-DAI is similar, S-dollar is like this. So in a way, these projects, they take the income they generate from the most speculative users to the last speculative users. And then you have the trading fees as liquidity provider, which is also like sustainable in the sense it's real business income, basically. And if you look into speculative yield, it's like this. So speculative is very different because what's advised is basically the 10% APR or even more. And people think, oh, that's awesome, that's a lot, sometimes 20. But the issue with this is it's only a week or two. So I calculate this for a week, it's like a fraction of a percent. So if you have $1,000 in this for 10%, you get $100. This is money. But for a week, you only get $2.70. So the question is it worth to shift your capital around if you just make $3 on the $1,000? So you need quite some capital to do speculative yield. Because after 2 weeks or 3 weeks, it's not there anymore, so you have to shift your position. It takes time, you have to research. It's work, basically. And so this is also why you always see this high API in the interface, and some of them, they are true, most of the calculations are right, but the issue with them is they're just there for very short-lived, basically. And for the real yield, it's not the case. Most of them are built on like sustainable business cases, so it's much more sustainable. This already told about. There's other yield. There's like yield from future airdrops, basically, where you speculate on future airdrops. And then, there's yield on new chains. It's similar to airdrops, but you move your capital or stablecoin to new chains. You farm the chain, you compound and take note. So this is the speculative side. It's just more short-lived. It also has another risk it's more risky. Yeah, it's more risky because it's untested project, so you need much more knowledge to go in the speculative field, basically. And then I'm coming to the end. So yeah, welcome to the jungle. Basically, this is a Guns N' Roses song. Welcome to the jungle. So I got the questions from as preparing this. I asked somebody, yeah, what do you want to know? How can we do it better? And the feedback has been, yeah, the UX of this stable yield-bearing stablecoin is not very good in the sense that you don't see the risk. And I think it's true. So there's no, of course, there are like projects who send you mails and they show you where you can get which interest rate, but there's no page where you can basically go and see all the compounded risk you take by using this, by doing this holding or doing this displays, basically. So I think the UX is still not very good. And the main reason is that I think that as a project, you don't have the incentive to show the risk, or as soon as you start showing risk, people also get aware of risk. So projects, they don't show you which kind of risk you compound. And it can be substantial. So if you do different things, what they also do, they leverage up. So you take the liquidity somewhere and then you even leverage up your position. You get more reward of this, but you also have like another risk in this. So it's like, at the end, yeah, this is what helps is you should understand a little bit what you're doing, or you should just go something who is like tested over time, basically, but then you won't get these high rewards. That's just how it is. Of course, you can just follow the trend of people and yeah, that's how I do it. But if I have like an inside view in this industry, so I know the players, I know their past. So if somebody makes a new project, I know these are good people. They do serious work, or are these guys more like for optimizing short term. So it's like it's not easy to find out if you're coming from outside. Then so one thing is like that basically. So regulation killed it. MiCA and also the Genius Act. So in the Genius Act, it's not allowed to have yield-bearing stablecoins. So government doesn't like that you basically can hold a dollar somewhere on chain and you get constantly revenue from yield-bearing from Treasury, from US Treasury basically, or for European Treasury. So in a way, the stablecoin, the fully backed stablecoins, they're not allowed to do these games anymore. Some do it, With Circle, you could, I think on Coinbase, you could have USDC and you got like a yield on this, but this is then framed, you get basically rewarded by Circle and not from Coinbase and not from Circle directly. So what's the future? And also, I guess if you look longer, I guess yields will go down as the industry will get more major. I think yield will go down over time because what also is an issue, this creates an issue as us as an AMM, is that, this is the yield of USDC on Aave. And it's very, very high at some point. It was very high. And the issue with this is if you are an AMM like us and people provide liquidity in stablecoin pools and you suddenly get like 16% interest rate somewhere, they move out their liquidity. So if you have a project or a stablecoin, you want people to provide liquidity for you, your project, you have to match this kind of prices, and that's very high. So it means for $1 million of liquidity you pay 120K a year just for $1 million of liquidity if this is like over a year, and this is a hefty price basically for liquidity. So in my opinion, okay, we like to play these games, but in a way it's like a chicken and egg problem somehow, because every new stablecoin entering the market depends on the cycle you enter. But if you enter in a high price environment, you have to need a lot of cash to bootstrap your system, and it doesn't help the overall industry. This volatility is basically, I think it limits growth basically. And what would be natural is what's still the case. Why don't you get on-chain you get these kind of rates, but off-chain not? So it's a high information asymmetry, or I don't think it's also about risk, but the risk is not this is not about risk, it's about market cycles basically. And yeah, that's the end. So over long term, many projects look like this. This is a chain. I don't say the name, but this is a chain getting. So this is like most of the projects are like this. This is speculative field. So as long as it lasts, you can enjoy. But I guess over time it will go down. It has to, and maybe it will help to our growth in the future. So that's it. Questions, and then I've like info about Curve and myself. Okay.
Hey Martin, thank you for the talk. It was pretty comprehensive on all the different risks that we can have on chain, be it from the protocol itself or the kind of yield that we're getting from. One question that I wanted to ask, I feel like something we take kind of for granted on the stablecoin space is that everything has to be pegged to the US dollar. We see this with Curve USD, we see with USDC. So I just wanted to make a bit of an open question, like, do you feel that in the future this USD position is going to be staying? Are we going to be seeing other non-USD denominated stablecoins? And how do you see this playing out in the future?
So the thing is, the dream market of Curve is FX basically. So we would like to have other stablecoins with big pools and traded. But what we did see is some kind of hyper-dollarization. So always every cycle we think, maybe now it will arrive, FX will arrive, but somehow my take is, and I did see it, I'm from Switzerland, our currency is pretty stable, but many people living in a high interest rate environment, basically they hedge to dollars. And because it has the highest liquidity, they hedge to USDT basically. And that's the short answer, because it got much more accessible. Before, basically, you had to go somewhere, and now you can do it on-chain, you can do it with small price, you can basically go with your local currency back to on-chain Curve USD. So we see some kind of hyper-dollarization. I'm not sure about, because now the dollar is under attack, I would say, currently. The dollar has issues, and it changed a lot of the picture last few months, basically. Maybe it will, if like Trump is not anymore in the US, maybe it will change back, it will get more into stable territory. But somehow, I guess, so it's really unclear right now. I guess it's attractive to make a stablecoin, non-US dollar ones, but you need a lot of trading on this to make money. And the thing is, it's more happening in LATAM countries or countries with not so good not very stable coins, basically. And I guess there is some adoption who's not coming from DeFi. We talk to some of the players, and they use DeFi as an intermediary, basically. And it's just basically sending money from one country to another. And then they do the swap, they do on-chain. Or basically, they go from a bank on-chain, and then they go again with the bank to the local currency, basically. And I think there will be adoption, but it's somehow we are not there yet.
Thank you.
Yeah. More questions? Or I know we have time. Do we have time? No. Okay. Thanks.